Okay, well, it's a real pleasure to talk to you, Amit, and great to see you again. And Amit is probably one of the cleverest people I know, and I know lots of clever people. So fortunately, he's going to talk to us today about Brexit, but also modelling and how we go about long-term modelling. So Amit is head of UK macroeconomic forecasting at the National Institute for Economic and Social Research, which is usually abbreviated as NIESR, which is a highly respected organization that produces these macroeconomic forecasts. So, Amit, would you briefly introduce us into the concept of modeling and why we need models in the first place?
Hello, Ramin. Well, great to see you after such a long time. So let me tell you about the Institute's macroeconomic model and what we use it for. So I think that the National Institute runs and maintains this very large macroeconomic model called NIGEM. Now, NIGEM is used by a number of central banks around the world and private sector organizations. Now, there are sort of two main purposes for which we use NIGEM. One is for doing economic forecasts, and the second and more important one, I think from my point of view at least, is to ask what if type of questions, right? So, what if Trump introduces tariffs or non-tariff barriers? What impact will that have on the economy? What happens if there's a sharp slowdown in China, for example? What if that happens if there's a tax increase? So these are the kind of stories that we can ask and answer with this model. Now, the model is useful because it provides a structure. Because the economy is very complex, the model tries to simplify those complexities by drawing the interlinkages across different sectors. So if you hurt or impact one particular sector, it obviously has it sort of resonates across the entire economy. And the model tries to capture those linkages. So I think that's really the strength of the model. It forces you to think through these channels in a structural way.
And for humans, it's really hard to think through these kind of second order effects, isn't it? So some people say that Brexit will be inflationary because it's going to reduce the pool of labour, but there are going to be second order effects on top of that. So NIGEM lets you step beyond that into the second and third and fourth order effect, right?
Absolutely. And and even the first order effect. I mean, if you say to me Brexit is inflationary for reason A, we can input that reason A, understand the full effects, and we can also understand for a different set of assumptions what kind of inflation effect will it have. So you can actually quantify the size as well, apart from understanding the interlinkages.
Okay, so would you like to talk about the actual uncertainties that come into these models? Because I know there's been a massive pushback in the UK from many politicians, in fact, Jacob Rees-Mogg being among the major detractors about modelling in general, because some of the forecasts when we had the referendum were wildly inaccurate. So people have lost faith in the ability of people to actually forecast what the impact will be.
I mean, a model is a model. It's an approximation of the world. The world is almost certainly different from an approximation. And in that sense, I think that said, there are a number of sort of well-established linkages that have been proven time and time again. And we rely on those to build our models. Now, in the context of Brexit, what is important is, I think there's two strands of sort of uncertainty. One is, well, we don't know what the future relationship between the UK and the EU will be or will turn out to be. But I think there's another strand of uncertainty which relates to the impact of whatever that outcome is on the UK economy. Now, remember that UK is the first economy and the only economy to exit from the European Union. In fact, no major country has exited from a free trade area ever, or certainly in recent decades. Now, as I said, I mean, a model typically looks and tries to understand through precedents. And because we don't have a precedence, there's an unusual amount of uncertainty around our forecasts, our estimates of Brexit.
Okay, so maybe you could talk us through the actual channels by which Brexit is going to impact growth in the UK And indirectly, it's going to affect markets because the people that watch this channel are interested in the market effects.
Absolutely. Now, here at NIESR, we've used NIGEM to try and quantify the impact that Brexit will have on the UK economy, both economic growth, inflation, public finances, etc. And we've identified, around half a dozen channels through which Brexit could have an impact. Our chief amongst these, and the one that's probably discussed the most, is the trade channel. And I think you can think about the trade channel in two separate ways. One is the additional tariffs that will be imposed on UK goods by the EU and vice versa, should we fail to secure an agreement and we trade on WTO terms. So that's a tariff channel. The more important channel, and when I say important, I mean in terms of the size of the shock to the economy, is the non-tariff channel. So the non-tariff barriers. So, for example, when you trade between the UK and the EU, there are no customs borders. There are no customs checks. Once a good is entered within the European Union area, it can trade freely. But once we're out of that area, there may be some kind of customs checks to assess, to check whether the goods are compliant with local regulations, etc. So that's an additional channel. Other than that, I mean, there's likely to be an impact on foreign direct investment in the UK, because the UK is going to become a less attractive place to invest, for the simple reason that because there are trade barriers, companies globally may not choose to locate in the UK if the main reason for locating in the UK is access to the EU.
And there was an open letter, I believe, from the Japanese about the car manufacturing industry in the UK and what would happen if there were these trade frictions.
Absolutely. I mean, the supply chains within the auto sector are incredibly complex. Not just complex because of this just-in-time management of inventories. They're also critical that you don't have delays at ports. I mean, that is simply one of the key reasons why the UK needs to maintain frictionless trade with the EU. But there are others. I mean, for example, other channels. For example, on the positive side, there's the fiscal contribution that we make into the EU. So the UK makes a contribution of around 0.5% of national income on average each year. So that's, the net contribution is about 7, 8, 9, maybe around 10 billion pounds. It changes year by year. But that contribution, we'll stop making some of that contribution. And to that extent, we could divert that money into the UK. There are other channels. Another important one that's been discussed quite extensively is, of course, migration. As a member of the EU, we allow free movement of labor. The UK is keen to stop that and be more selective in the type of workers that enter the UK economy. And that's a huge unknown just to try and quantify that channel. But we make a stab at it. Another big unknown but important channel is productivity. So the reason why productivity is important is ultimately, our welfare depends on how productive we are as a nation. But we also know there's plenty of evidence and research that suggests that open economies tend to be more productive for the simple reason that we're able to choose the best skills and best resources and take advantage of our competitive strengths in an open economy versus a closed economy. Again, I mean, the research on this front is not so compelling, but all in all, I think we generally believe that restricting trade will have a negative impact on productivity. And I guess the other big unknown is, as the word suggests, uncertainty. When you are sort of treading into unknown territory, risk premium on assets goes up. So, for the same stream of dividends, you will simply pay less because you're going to impose some kind of risk.
So, for example, for an equity, if the equity risk premium goes up, then the price of the shares falls, right?
Absolutely. Even if you expect the same performance for the company in the future.
Yeah.
So I think that's a big unknown, and not just equity prices, but you would expect that to occur with exchange rates. You could expect that to occur on the bond yield, on the sovereign bond yield, on corporate bond yields, etc. And all these have then, tend to hold back economic growth as well. So there are a number of channels through which Brexit could have an impact on the UK economy.
So one of the beautiful slides that you've got in your presentation, Amit, is about this beautiful triangle, which shows the Great British trade-off with our deal with Europe. So what are the dimensions that matter, and what compromises are we making for each of those dimensions? So perhaps you could talk about that triangle, which will magically appear now as you speak.
I mean, the negotiations are complex, and they encompass many, many different dimensions. But what we've tried to do with this triangle is just distill the negotiations into what we think are three key areas, or certainly key areas from an economics point of view. And the three areas are: one, access to the EU, and of course the EU's access to the UK for both goods and services. So that's the top corner of the triangle. On the left-hand corner, you have the fiscal contribution that the UK makes into the EU, and then on the right-hand side of the triangle, you've got movement of labor. But in our view, these are absolutely the three key areas of negotiation. So what the triangle tries to show is the sort of trade-offs that we face in our negotiation, and what is it that we want, and what is it that the EU might offer us. So you could think of the origin of the triangle as one where, we're not members of the EU, we're just another third country. So one where we do not trade, we do not have any special access into the EU market, one where we make no fiscal contribution into the EU, and one where you don't have any agreement or movement of labor, or free movement of labor. Now, the triangle as it stands now, the outer triangle, is the position of the UK currently, where we have full access for what goods and services into the EU market. We allow free movement of labor, and we make a fiscal contribution of around 0.5% of gross national income. Right? So that's where we stand currently. But the EU has struck a number of trading relationships with other third countries: South Korea, Canada, most recently Japan, Turkey, Switzerland, Norway, etc. So how do those deals compare with, say, the Chequers deal or others? So we kind of try and show that in the context of these three dimensions. So let's start with, for example, the Swiss deal. Now, the Swiss deal is more or less kind of restricted to goods trade. So it's less ambitious compared with our current position with the EU, which is for both goods and services. So it's not quite at the as big in terms of the triangle as the UK's current relationship with the EU. Again, Switzerland makes a fiscal contribution to the EU, which is much smaller than the UK's contribution, but there is still a contribution. And similarly, Switzerland allows a very high level of high level of movement of labor between itself and the EU. Okay, now the EU also has a special relationship with Norway. Norway is part of the European Economic Area, and as a member of the EEA, Norway has a very high level of access to the EU market for both goods and services. So you can see it's pretty much as close as it can be as a full EU member in the triangle. Now, in order to have that privilege of access, the EU also allows almost full movement of labor. So again, it's at the extreme end of the triangle. And Norway makes a fiscal contribution as well. Now what the UK is looking for in terms of Chequers is quite an ambitious trading relationship for goods. It's relatively silent on movement of labor, and it's completely silent on the fiscal contribution. So you could almost think of the UK wanting to be to simply have access to the EU market, not really wanting to make any fiscal contribution, and not allowing movement of labor. Now, this is going to be unacceptable to the EU. As you can see from these triangles, there are trade-offs. The smaller the access that you have to the EU, you either make a smaller fiscal contribution or you get some concessions in terms of movement of labor, like the Canadian deal has. So our sense is that the EU will simply not accept the Chequers or the white paper proposal. They will insist on some free movement of labor and a fiscal contribution. If the UK wants to have a more ambitious deal with both goods and services, then I think it's almost certain that the UK is going to have to allow something as close to Norway or Switzerland on free movement of labor.
And could you comment briefly on Canada? Because that's one of the ones which the Brexiteers, I think, in particular support.
Sure. I mean, the Canadian deal, at least in terms of access to the EU market, is quite similar to Switzerland. So it's largely goods. Canada does not make a fiscal contribution into the EU, which is something that's quite attractive to the Brexiteers. And movement of labor is extremely restricted, which is another attractive feature of the Canadian deal. Now, in terms of the Brexiteers looking for a Canada plus plus plus, it's essentially looking to have more access to the EU market for both goods and services, and sort of an unfettered access, which in my view is not realistic, for the simple reason that if the UK has this sort of exceptional access, then it does beg the question that why other countries other members of the EU and other countries who have reached trading relationships with the EU not getting a deal that's as good as the UK.
Great. So those are the kind of principal axes by which we could classify the different trade deals. So now moving on to the final step, which is putting those assumptions into or those different scenarios into a model, NIGEM, and then working out what the consequences are. Could you briefly talk through what the consequences would be for growth?
Sure. Now, as I said, I think the first point to make is there's an enormous amount of uncertainty around these. Even the white paper proposal is simply a proposal that's made out of, half a dozen sides of an A4. It's not a full trading relationship. So it's really our interpretation of that document. But I think the sort of broad gist of the proposals are reasonably clear. So what we've done in NIGEM is applied those half a dozen channels to each of these trading relationships. And what we have found is that if you did restrict trade on WTO terms, that would knock UK GDP growth quite substantially. I think our chart shows that growth will be more than a percentage point lower. The currency will depreciate, and that will raise inflation by more than a percentage point. This would imply that household real disposable income will be squeezed, and over the longer term, UK will be poorer than in a situation where we remain members of the EU, or in a situation where we reach a soft Brexit deal with the EU. Our central forecast, by the way, is conditioned on a soft Brexit scenario. So what we mean by a soft Brexit scenario is one where the UK maintains a very high level of access for both goods and services into the into the EU economy, and where financial markets function normally. So there's no major dislocation in the financial markets. Now, you could easily think of scenarios where financial markets are dislocated. You could think of scenarios where, that's one extreme. You could think of a scenario where we actually remain in the EU. There's a second referendum. So we're not thinking about extreme outcomes. We're just thinking about an outcome where you have a soft and solid trading relationship, probably somewhere, something that looks like the one that the EU has with Norway. So that's our kind of central scenario. Under that scenario, we see growth of around 1.75% over the medium term. Inflation is more or less on target, And
So wait. So 1.75%. How would that compare with long-term GDP growth in the UK? Say that if we imagine that Brexit hadn't happened.
I think, well, it would probably be marginally lower than a scenario where Brexit had happened altogether. But maybe another way to sort of think about this is, what was the average before the financial crisis? Because I mean, there's been a material slowdown in the economy since the financial crisis, primarily because productivity has been weaker. And prior to the financial crisis, the UK was probably growing by around a percentage point higher. So in the sort of 2.5 to 3% region, as opposed to the sort of 1.5 to 2% region that we have in our sort of soft Brexit scenario. And I think that's important because, I mean, you're hitting the economy with two shocks. One is the financial crisis, the productivity impact of that crisis, and other reasons because of which productivity has been damaged. And then over and above that, you're hitting with the Brexit shock, which potentially has long-term consequences to it as well. So in our sort of hard Brexit scenario, this is one where the UK trades on WTO terms. We see growth materially slower, dropping by around a percentage point. The main reason why growth drops in the short term is because access to the EU market is blocked for both goods and services. Our underlying assumption here is that our exports to the EU will be something like 50% lower in the long run. And those are the kind of results that we've got from what they call gravity models, where they've said that, this is, as a member of the EU, trade with the EU has increased by 50%, something that wouldn't have happened if we were not members of the EU. Now, of course, one of the criticisms of those studies, just because trade increased by 50% as members of the EU, it doesn't mean that if we exit, that trade will fall by 50%. It might fall by less, just because we've established some links with the EU, or you can circumvent these rules in some other ways. And to that extent, the numbers that we present might be too high. But that's the best we have so far.
Okay, thanks, Amit. That's really interesting as an insight into the economic modelling of Brexit. But what I'd love to talk about is the effect on sterling, because I've done a Brexit video where I talked a lot about the asymmetry of the reaction from sterling to Brexit, because we're already pretty much pricing in a hard Brexit now. So if there's any good news, we'll probably get a stronger rally in sterling than we'd get a downside if we actually get a hard Brexit. So what are your thoughts about that? Because I think your insight is based on central bank policy, and it's a very interesting insight.
Sure. So I think if you go back to 2006, when we had the referendum result, the inflation in the UK was significantly below the 2% target. There was still some spare capacity in the economy. And I think if you remember, the PMIs and other sort of indicators of growth collapsed on the news, more or less. So the bank was comfortable with injecting stimulus into the economy to lift aggregate demand. Now, 2.5 years on, unemployment is now down to 4%. There's very little spare capacity in the economy on conventional measures. Inflation is, well, the latest print is 2.7%, which is well ahead of the target. And economic growth on the latest numbers was 0.7%. So on our NIESR GDP tracker, we think Q3 will be 0.7% and Q4 will be 0.5%. In other words, there's very little spare capacity in the economy. And if we get a hard Brexit, it's the view of the central bank that the productive capacity of the economy is going to be damaged. And given that the central bank's primary mandate is to hit the inflation target, against a background where the productive capacity is falling, there's very little room for maneuver. In other words, there's very little room to cut interest rates. So unless economic growth drops significantly, I think the central bank will be hesitant to inject stimulus in the same way as it did in 2016. Now, if that is the case, then I think sterling will remain supported.
So, in other words, the downside on sterling will be fairly limited in that case?
That's right. I mean, unless economic growth slows down very sharply and it remains weak for a prolonged period of time, I think the stimulus from monetary policy will be absent this time, or certainly not in the same way as it was back in 2016.
That's been really interesting. Thanks so much for your time, Amit. And thank you also to the National Institute for Economic and Social Research for allowing you to spend the time with me. And hopefully we can talk about this again once it actually happens.
Yes, good to chat with you, Ramin, and let's be in touch.
Now, I hope that's taken you beyond the usual soundbite understanding of how we model the UK economy and given you some insight into what could happen with sterling if we do get a hard Brexit. Amit's view is that it'll be supported by the fact that the UK economy is at full capacity and the Bank of England won't be able to cut rates from where we are now. If you want to carry on seeing videos like this, then please do support us. It costs just $5 a month. Preferably you'd pay $10 a month like Robert Bradbury, Adrian Green and Ian Stenton. And if you do, you can take part in our live Q&A sessions and ask any question you like. So as always, thank you for listening.